Hi, everyone, and welcome to this week's edition of What's Driving Token Prices. I'm your host, Katie Talati, Director of Research at Arca. For those joining us for the first time, I'm responsible for identifying and analyzing digital asset and blockchain opportunities for Arca's funds. As part of our research, my team and I examine token prices and the market events that act as catalysts for price change. Based on our market research and market events over the past week, here's some notable token price moves and what we think drove these moves. As a reminder, this commentary is not intended to be investment advice, investment research, or an investment recommendation. Please consult your investment professional for your own circumstances. Well, guys, it has been quite the week, and welcome to November. We're officially in the home stretch of the end of the year. If you missed it, the crypto market suffered quite a sell-off over the weekend that led into Monday and Tuesday of this week. Seems that we're bouncing back a little here. Bitcoin even dropped briefly below 100K, which definitely had a lot of folks worried. But we've had some interesting things happen in the crypto token world. So we're going to talk about that to get going today. So first, we're going to talk about Stream Financed. So I don't usually do too much on stable coins, but this one was kind of important because it had a lot of far-reaching implications. So on Monday, Stream Finance, which is a DeFi yield protocol, announced that one of their managers had suffered a $93 million loss in assets that it was managing on behalf of Stream Finance to back the staked Stream USD or xUSD stablecoin. So Stream decided to disable withdrawals and deposits on xUSD as a result. But since xUSD is tradable elsewhere, the stablecoin quickly lost its peg. In a way that kind of further exacerbated this issue, xUSD was also utilized in a number of different lending protocols that employ what are called modular vault architecture. Modular vault architecture. So if you're not familiar with what that is, modular vaults are basically instead of having like a lending pool where you lend assets that are kind of like commingled on both sides, so risk is shared across the protocol, they have individual strategies or vaults. And the idea is that you can basically analyze the risk in that one particular vault and that one particular strategy, and decide if like the assets that are being posted as collateral are good enough, that the managers are doing good enough risk managing, and then you can lend or borrow from that vault specifically based on kind of your own analysis. Because of this, and usually these are considered safer because basically what it does is it means that any potential bad debt that one of these lending protocols could suffer from is going to be isolated to those specific vaults and not spread to the whole protocol. In many of these modular vaults, though, that were supported across DeFi protocols like Morpho, Euler, Gearbox, and Silo, they also use something called a looping strategy, which is something in crypto where basically users are allowed to lend and borrow the same asset multiple times to amplify their yield. So basically the idea is like you can, borrow USDC from somewhere, then go somewhere else, deposit it, get, USDT, and then lend it back to the same strategy, borrow the USDC, and do it again. So these strategies have been very popular in crypto, but it obviously causes potential for cascading risk or cascading liquidation risk if an event like this happens where there's a big depeg. Again, this is safe as long as underlying assets are sound and don't depeg. However, the depegging event in xUSD really caused a lot of these strategies to unwind, and a lot of users were rushing to kind of redeem their assets during this time. This chain of events really just shows how important it is for you to research any yield strategies and for the managers of each of these strategies before deploying capital into them. Although they're not like directly responsible, some of the DeFi protocols like Silo, Morpho, and Euler took a pretty big hit. They were down 14, 15, and 32% respectively as a result of this big unwind. In addition to that, Silo also announced today that they're going to be taking legal action against Stream Finance to recoup user losses. The xUSD stablecoin is down 89% since this unwind began. Okay, the other big news in crypto this week was that Balancer early Monday morning was exploited for about $110 million. So Balancer is a decentralized exchange. They've been around for quite a while, almost 10 years. And they get used quite widely on a bunch of different exchange. The attack specifically, though, targeted their version 2 of the protocol's composable stable pools. And basically it allowed withdrawals of wrapped ETH and then staked ETH derivatives like OS ETH and wrapped staked ETH. So the hack is believed to be the result of a rounding error bug, which is essentially when code basically when you allow like a computer to like have a numerical calculation. A lot of the time what can happen is the computer can approximate a lot instead of like coming to an actual exact result, and that can lead to a small inaccuracy that can then be exploited if it's exploited multiple times over and over. So this bug fault combined with like a faulty access control mechanism allowed this this user to come in and make unauthorized withdrawals from these ETH and ETH derivative pools. So Balancer, like I mentioned, is really widely used. It's actually been forked across a bunch of different protocols. So there were actually losses not just on Ethereum, but also on Base, Polygon, Sonic, Arbitrum, and Optimism. In the case of actually Berachain that uses a fork of a Balancer, the project has decided to fork their own chain to avoid these losses. Balancer is now down 16% on the week. Okay, now another one in one token that has kind of notably managed to buck the overall market trend this week is the privacy token Zcash. So basically, this was a confluence of factors that has led to Zcash's massive run up, but interest in the privacy focused layer one has really reignited over the past several weeks. So because Zcash specifically offers opt-in privacy features known as shielded tokens and shielded transactions, but it's not totally like a 100% private chain like a Monero is. As a result, people are starting to latch onto a narrative that it provides a better alternative to Bitcoin, which some believe is becoming a more mainstream asset to Wall Street focused. But like Bitcoin, Zcash uses a proof of work consensus mechanism and has a fixed supply schedule. So Zcash has long differentiated itself by using zero knowledge proving technology to shield transactions, which I think I've talked about in the case of using zero knowledge proofs, specifically actually for scaling solutions in a lot of layer two protocols. But in this case, they're really using it simply for like that privacy feature. But this is obviously something you can't do on Bitcoin. So that's kind of like the main thing that people are very excited about. In the month of October alone, Zcash saw their private pools rise 11%, and the number of shielded transactions went up about 36%, leading some to believe that there may be some actual usage happening on Zcash and not just speculation. The past few weeks, though, it's also seen prominent crypto figure Arthur Hayes predict that Zcash could reach $10,000, which has further fueled interest in the project. $10,000 per token, that is. And then this past week, the Electric Coin Company, which is the for-profit company supporting Zcash development, released their Q4 roadmap, which is focused on enhancing user privacy and wallet usability. As I said, Zcash has managed to buck the trend. It is up like 400% in the last month and up 42% just this week. All right, guys, that's all I have for you this week. I hope you enjoyed our insights. Tune in here again next Wednesday at 1 p.m. Pacific to hear what's driving token prices.